Good morning, good afternoon, and good evening, everyone, and welcome to the Thursday edition of the Daily Stack. This is our Macro Thursdays, and wow, do we have a packed event scheduled for today? There is only one true indicator that matters at the moment, and that is oil. Oil is dominating headlines. It is causing huge ripples throughout markets, resulting in what looks to be a pretty weak bounce for the last week. Markets are looking soft. We've got a lot of red data coming in. We are discussing anything and everything related to oil, the implications thereof for the potential, stagflation that we might be in this new environment. Feb inflation data is a totally different world to where we are now in the last 30 days, given everything that's happened. Anyone who's joining us on YouTube, on X, please drop us a like, drop us a comment. We'd love to respond to any and all feedback you guys are giving us, whether that be on YouTube or on X or on Rumble. We're streaming across a variety of different platforms. Shoot your questions in for Robert Infra. We are joined. Thanks so much for hopping on for the stream with us yet again. Robert, I guess let's start off with how you doing?
Well, I'm pretty tired, but yeah, there's really a lot going on with oil, like you mentioned. This I would equate this to kind of a January 2020 sort of setup. So yeah, it's I think it's about to get pretty interesting. We have the S&P 500 down 1.1, testing the lows. We have oil up 4.2%. There must have been news. I saw a headline. There was this is a very headline driven market, so you definitely have to keep an eye on the news wire these days. But yeah, we got oil moving higher. We got the S&P 500 moving lower, basically risk moving lower. It looks like yeah, Bitcoin down 3.3%. So anything risk is getting crushed. Gold is also down 2.7%. Gold, I think we could start there. So, what is going on over in the Middle East? If I can find the chart. Um, where is it? Here we go. So, all the countries involved with the conflict, they are all pegged, not all of them, but the vast majority are pegged to the dollar. It looks like we're having a move in the Qatari rial right now, like currently, but generally pegged to the dollar. And so, when these countries rely, some of them, on tourism, Qatar, for example, but when you're talking about, the amount of disruption that we are seeing in the Middle East, this is going to put pressure on their revenue, on their income as a country, and it's going to pressure the peg. And so, these countries generally run a current account surplus, generally a trade surplus, right? They export all this energy, and they accumulate foreign exchange reserves. Well, some of those are going to be gold, and so I think what we've seen, if we zoom out on gold, we'll go back here, zoom out to like the daily, gold is down pretty significantly, and this is part of why Bitcoin is outperforming. So right now, about 18%. Part of what is going on here, I think, is the fact that these currencies pegged to the dollar are being pressured due to the fact that their economies, they're in a full blown regional war right now. So yeah, I think that is part of what is gold.
Yeah, I did a little bit of research in the background, and it turns out Kuwait derives roughly 90% of its government revenues and 40 to 50% of its GDP from
Yep.
petroleum exports. So in terms of the dollar linkage here, it's incredibly strong. So maybe play through exactly the gold. Like, let's see the what 3% dump in gold today and the 18% dump. Are there other countries similar to Kuwait? And your thesis is here that this dump is directly attributable to those countries and their foreign exchange correlations, right?
Correct. Yeah. So I think that, the countries we're looking at here, Kuwait, UAE, Qatar, Bahrain, they're all pegged to the dollar. Their revenue, like you mentioned, the the degree to which oil exports are important is outsized, right? It would be the equivalent of in America if consumer spending, I don't know, think of like a virus that goes through the payment processor at the store, right? And consumer spending just grinds to a halt. It would be equivalent to that, what they are seeing with oil. So yeah, your country, the majority of your GDP is coming from this one sector. That sector, the refineries are getting damaged. Exports are, at a standstill due to the fact that the strait is effectively closed. Here is Bloomberg showing that data. So anyone with a Bloomberg can, or subscribe, sub to the Bitcoin, to the Bloomberg news. You can pull this up, and it's ground to a halt. So when your exports are grinding to a halt, when tourism, right? If you're Qatar, they rely a lot on tourism. Well, that's obviously not doing well. We know airplanes, flights are getting canceled if you can even get a flight, right? So you can't even get into Qatar to be a tourist. And if you are, there's, hotels that are being attacked by these one-way drones.
Yeah.
So, your revenue is you're already getting hurt pretty badly economically.
So then maybe just tie that back directly to gold, because let's say, okay, your GDP has now been severely impacted due to this significant shock. How is that translating directly into the 18% correction in gold?
Well, it's not just GDP, it's dollars, right? Like it's revenue, it's income. And when that dries up, you have to, you got obligations back at home, right? You got to pay the police, the fire department, if you have nationalized healthcare, you got to pay the doctors. You have obligations you have to pay. And you have a peg, right? That you have to defend. So yeah, what are you going to do? You're going to sell foreign exchange reserves, and that is probably what they're doing. FX reserve holdings are delayed by, I think it's a quarterly data set for them. So yeah, we probably won't know for a while now. It's the end of Q1. We might, yeah, maybe we see a dip for Q1, right? But it could be a while before we really know for sure. But if I had to guess, that's probably what's going on. I mean, you also do have a move higher in the dollar. If we go back to the end of February, where the conflict broke out here, DXY up 2.1. Not a crazy move, but a move higher in the dollar. You're going to get you're going to get weakness in gold.
Yeah, I mean, the question then
And
this
not only that, but you have rates going vertical.
exactly? So yeah, so let's that was kind of where I was going with this. Is rates are going vertical at the same time,
Yeah.
which just creates an absolute cluster, yeah, of crazy conditions, which is really the real story here.
Yeah. So if you look at the real rate, or the way that, the easy kind of quick and dirty way to calculate the real rate, which you take the 10-year treasury yield and you subtract out the 10-year break-even inflation rate, which is a market derived interest rate. You're getting a move from 1.6. So you're getting a 50 basis point move higher in the real rate. So what that is the amount of yield over and above inflation that you're getting if you buy a 10-year US Treasury. So that move in real rates definitely also going to pressure gold. Historically, gold has had a very negative correlation, inverse correlation with real rates. That correlation broke down, right? Like 4 or 5 years ago. But it appears to be kind of coming back.
So I guess how aggressive is this move relative to existing moves based on the chart that you're showing us at the moment? It doesn't look
Yeah.
that bad, right? I mean, if you look at it, yes, it's 50 bips over a very tight time frame. But if you look at something like July, there's also a massive spike, and some of
Yeah.
the other
Yeah.
periods of time where it just shoots higher.
Yeah, it's way worse in the rest of the world, right? Like Great Britain, this is their 10-year gilt, and you can measure it up 70 basis points, right? If you look at the 2-year gilt yield, they're indicating a rate hike. I can actually pull up the yield curve here. So their interest rate right now, their overnight rate, TradingView will load. Yeah, they have seen a wild move in their government bond market. So right now it looks like the interest rate, I think it's down here at like 3.7, memory serves. 4. Yeah, 3.7. So right now their interest rate, overnight rate, Fed, overnight deposit rate, 3.7. And if you look at their 2-year, it is trading at 4.5. So that's just off the top of my head, that's 3 hikes over, just over the next 2 years, which is brutal. I mean, Great
Yeah.
Britain cannot sustain that many hikes.
So I guess what is the logical, like, how does this play out if there is such an aggressive move up to the upside?
Yeah. So, well, over in Great Britain, over in Europe, they have a bit of a different, approach, I guess you could say, to central banking, which is they don't have a dual mandate, right? Here in America, we have the Fed, right? Worried, their mandate is stable prices, right? So inflation, but then also what they call full employment. And that is kind of, on the inflation side, they want to make sure that inflation doesn't get too bad. But then on the growth side, they want to make sure the labor market is okay. And in Great Britain, in Europe, they don't have that. They only have an inflation mandate. So you get an energy price spike. And by the way, it's like way worse for them because they obviously are short the dollar. And what is the dollar doing? It is going vertical. So you have not only the issue with oil moving higher, right, to a significant degree, but you also have your currency being pressured, whether you're talking about the pound, whether you're talking about the euro. So you're kind of getting hurt both ways.
Yeah, it's basically just like a complete bloodbath either
It's
way.
really bad.
When you slice it,
Yeah.
it doesn't really get any better.
So in addition to the move in Brent, the euro relative to the dollar is down by about 2.3%. So what could happen here, and I hear a lot of people talking about oil and kind of what could come and all this kind of thing, and they mention, well, yeah, but the US, we're a net exporter, right? We produce more oil than we consume. That is
Everyone
true.
thinks that this protects us, right? So as a
Correct.
net exporter, we should be relatively, I guess, relatively being the key word, insulated from this supply shock.
Correct. But the issue is, well, there are a number. So, number one, oil is traded internationally. Also, you look at America, like I live in California. Here in California, you would think that our oil comes, and our refined products come from US refineries, but they don't. So, actually, it's like a third comes from Asia. I don't know why, but that's a different discussion. But right, you're fragmented even within America. So yeah, on the whole, America is a net exporter. But once you really drill down into region, some regions could be hurt just as much, maybe not just as much as Asia, but much more than a different area of America might be hurt. So I think that part is important. Number one, when talking about the insulation effect that America could have. I think the other interesting or notable thing that people don't talk about is, okay, so here we'll do dollar euro, and then we'll also look at the price of Brent futures. So since the conflict started, got to go to a lower time frame here. Yeah, Brent's up 31%, and you have not only that, kind of pressuring your economy, right? Going back to what we were talking about with Bahrain and Qatar and those countries, right? Same kind of thing. We're talking about the current account for Great Britain, for France, for whoever. That is going to be pressured by the move in oil. You need to import oil. You are not a net exporter if you're in France, for example, right? So you have to import oil. The price of that oil is going way up, number one. Number two, the price of oil is going up in dollars, right? Most petrodollar, most people know, most commodity transactions are denominated in dollars, but you're in France, right? Where the world is the euro. So you're short energy and energy costs is going vertical. You're short dollars and the dollar is strengthening. You're getting hurt really badly. So what do? You sell some of the US Treasuries that you have accumulated. We can go back to 2022, which was kind of the last recent history example of an energy price spike. And
Sorry, just to clarify, that was the UK, the Russia spike, right? That caused that fluctuation. And I was actually
correct.
going to look at that as a recent comp to see how long, because it feels like the market is pricing in a similar situation. If you look at the time that it took, oil's been grinding steadily down for the last however many years since it peaked back in 2021, 2022 with that spike. And ever since it's been coming back down. And it feels like the market is looking at that and saying, hey, well, let's hope that this is a similar situation to that without pricing in the risk that there is a substantial upside oil and move here. Still price, like, that risk doesn't seem to be priced into the market. Yes, some of the markets are trending lower, and we're seeing some red, but it doesn't feel like that externality is fairly reflected into.
Totally agree. Yeah, totally agree that right now risk is underpriced. The tail is pretty fat in my opinion, and it's still probably mispriced. So, you have the VIX right now at like 27, probably last I checked. Yeah, I do agree. I think it's really interesting to try to find a parallel. The other parallel to 2022, but to finish that point, in 2022, can go back here. So China, Japan, Taiwan, South Korea sold about $500 billion of U.S. Treasuries during that price spike in 2022. Remember, they rely on energy imports, right? They are not a net exporter. They are reliant on energy imports, and the price of energy in 2022 was going, vertical. England, Ireland, France, Germany, and Italy sold 164 billion in U.S. Treasuries. And not only that, but foreign equity holdings fell by more than 1.3 trillion dollars. So, foreign oil goes up, foreigners sell U.S. Treasuries. Selling of U.S. Treasuries causes our rates to go up, right? Inverse relationship there with rates. So rates up, that attracts more capital into the dollar. More capital into the dollar strengthens the dollar. Well, what does that do if you're in Europe or Japan or China or South Korea? That makes your burden, the energy bill, go up even more, even if oil doesn't go anywhere. Even if oil is not continuing to move higher, even if it just goes up to 120 and then it stays there and it doesn't move, if the dollar continues to strengthen because you have gotten into a reflexive feedback loop where foreigners are selling US Treasuries to raise dollars to pay for their energy, you're going to get a stronger dollar and therefore a higher energy bill for Europe, higher burden. So what does that mean? So that means more US Treasury selling, higher rate, more dollar strength, increased burden, increased cost for Europe, for Japan, South Korea, more US Treasuries, right? And it goes on and on and on. And that's kind of the dollar milkshake theory, kind of variation of it. But there's also the equity market feed through, which is, we saw they also sold $1.3 trillion of US equity, US stock. Well, what does that do? If you look at American GDP, 2/3 are consumer spending in America. Of that 2/3, the top 10% of income earners account for half. Well, that top 10% of income earners, they own all the equity, right? And the stock market's been going up, so they feel very rich. They feel rich because their portfolio is green. They spend more money, right? Everything is good. But when the stock market starts to go down, that wealth effect, which was a positive contribution or driver, flywheel to consumer spending and therefore to GDP, it goes away. It goes in reverse, and you get a negative wealth effect, and they pull back very quickly, and you're in a recession, and that's to say nothing of kind of the average American who is really not doing well.
Well, sorry, because there's a lot in what you just said. First off, I think the key takeaway is that probabilistically speaking, oil prices don't have to continue to spike higher for this to be a massive problem. The reflexive loop that you mentioned is just as terrible if oil prices remain elevated. They
Yep.
don't have to
Even if
necessarily go up to 120, 150, 180 a barrel, and spike to that level to cause even further disruption, right? So that's
yeah.
the first takeaway. If that's the case, then if there was a base case, an upside case, and a downside case, the base case should assume that oil is going to continue at current levels. Let's put that aside for one reason, because for one moment, because I had another question for you on specifically the US's quote unquote insulation to this. And if there is a recession and some of these top earners do stop spending, doesn't that balance that out because of lower consumption and therefore ease that burden, to some degree? Like, isn't that
what burden?
well, so typically, if there is a recession, like, isn't there going to be less demand for oil and less
Oh
spending?
yeah,
So
absolutely.
surely
Yeah.
that balance
Yeah.
out to some degree the need for the US to be more reliant on that, that one third that you mentioned, right? If two thirds is
Yep.
foreign and one third is, so there must be some kind of scenario where if there is a recession, that's demand destruction, which cancels it out. Now, it doesn't fix France's problem or China's problem or
Oh
Korea.
no, they get the same. They just get it worse, right? They just get a worse recession.
Exactly.
And this is the math behind it, right? We're talking potentially a depression. If this continues for another couple months, you're talking a global depression. I mean, it's really that bad. There's just no other way to describe it. Very, very intelligent commodity expert kind of people are using that word, depression. Like
So,
this is the math, right? 105 million barrels per day of global oil demand. Here is I've done my best to keep up with every little detail, every refinery that gets hit, every tanker that gets hit, right? Not just in the Middle East, by the way. There's stuff going on in Texas. There's stuff going on in the Caspian Sea, right? Mediterranean. There's is not just the Middle East. So I've done my best to keep up and track all of this. And according to my math, now this I want to say, this is kind of squishy, right? Like you could get Strait of Hormuz 20 million barrels. Okay, maybe they reopen it kind of, right? Maybe one or two tankers is able to get out per day, and that 20 million is really 19 million, right? But then maybe that the SPR release, 2 million barrels, maybe, in a couple months, the SPR is gone, right? That's only going to last like 2.5 months, the EIA release or IEA. So yeah, it fluctuates, right? You give a barrel here, you get a barrel here. Like it's definitely squishy, but when you look at it, generally speaking, you're talking a disruption of supply equal to Q2 of 2020. And just to remind folks, during Q2 of 2020, GDP was negative 31%. At that rate in Q2, at the rate of economic activity that was required to destroy 23 million barrels per day of oil demand, at that rate of economic activity required to destroy that much demand or consumption of oil, the US economy was shrinking. It was giving back a third of its wealth, size, whatever you want to call it, every single year. So it's really bad. Like, it was, to put it this way, Q2 of 2020, the U.S. economy, the degree of economic contraction was 235% worse than the depth of 2008 Great Financial Crisis. That is what is required to destroy 23 million barrels per day of oil demand. It is bad. And look, the difference was back then that demand was collapsing due to two things. Number one, the government was, hey, lockdown policy, got to stay in your house, whatever. The government could undo that, right? And boom, a lot of activity comes back, a lot of demand, and therefore economic activity. Number two, they printed a gazillion dollars, right? That's a technical term, by the way.
Yeah. You can
When
look
you're
it up
talking,
in Wikipedia.
yeah. When you're talking about oil supply being taken offline, you cannot print oil. So there is no magic bullet here. The only way that this works, you get those refineries that are damaged, some of which, by the way, they're saying are going to take 5 years to come back online. You get those back online. You get all of the oil out of the strait. And by the way, from Kuwait on the inside of the strait to Japan, Australia, it's like 2 to 3 weeks transit time, right? So it's not an immediate thing. You're talking about supply chains again, right? Just like 2020, they don't move overnight, right? So, yeah, you either have a like overnight solution, everything is done, everything is better, like magically overnight, right? And you get all this oil kind of back up the capacity. You drain the inventories, get that out, you ship it out, right? And wait the 2 or 3 weeks to get it to Europe, to get it to Australia, where 500 gas stations are already out of oil, out of gas, out of petrol. Like we might already be past the point of no return for a recession. Now it becomes a question of, are we going into a
How deep
depression?
is that? Well, so okay, so let's start off there. So how deep is this quote unquote recession, and how do you define depression first of all? Because when I hear depression, I think like 1920s, 1930s,
Yeah.
like that kind of significant GDP shock. And hopefully it's just a shock and not necessarily anything that's persistent, because that's kind of what it feels like the market is again pricing this in and looking at COVID and saying, hey, look, that's our downside. Whereas in reality, the government and demand could come back online to absorb that shock. Whereas here, because it's a supply shock, as you're saying, it's not something that can necessarily be fixed overnight. And even if supply does start to come back online, that probability of all that supply coming back online day one is almost zero.
Yeah. Well, I would contest that the market is pricing in anything close to Q2 of 2020. So yeah, so like right about here on like day 2, day 3 of this drop, this is where we are now. Look at how much further the S&P 500 fell, right? You can measure it. From basically, kind of where we are today, 6-7% off the high, it fell another 32% very quickly too.
And sorry, this is what you're showing here is, let's assume that like if oil does spike to 150, 180, whatever, 200, a crazy number like that,
Yeah.
this is the kind of impact that you would expect to see, excluding the additional risk, which is that supply might not come back, be able to be shipped and
Yep.
come back online immediately, which is kind of what
So
happened in COVID, where they printed money, the governments opened up, and there was all of that new demand to absorb to basically absorb that shock, right? Whereas here, it's not exactly as quick to respond. So there's potentially an additional further drawdown, which is that externality that that the market's also not pricing in. So there's two massive risks here that are not being appropriately
yeah.
represented by the financial markets, at least the way that you and I potentially perceive them to be.
So the Strait of Hormuz, 20 million barrels per day, theoretically, if you could get that open today, right now, you are a lot of the way there. You're right. You just brought back 20 million barrels per day. You're a lot of the way there. You're only down to a 5 million barrel per day demand shock, which, by the way, is still four-ish X worse than 2022. Even if we were able to get that 20 million barrel through the strait, even if we were able to get that back online like today, you're still talking a disruption that's 4 times worse, 300% worse than 2022. right? And we know in 2022 that a couple things. We know that, for example, the labor market was red hot. The quits rate was up at 3%, which was a record high, right? So the labor market was red hot. We had just printed, if you look at bank reserves here in orange, right? Liquidity was a wash. M2 was growing at like 6-7%. Right? That was the environment where oil went from 65 to 120. Now, M2 growing at 1.4, you have the quits rate down at 2, right? The labor market is not doing well already. And by the way, liquidity is not doing well either. Yeah, they're doing the RMPs, but it's very minor in terms of adding liquidity. And if you look at broad money, right, the private bank money, it's very poor. It is rolling over as the yield curve continues to flatten. We're very anemic private credit creation. So yeah, the ability, and I could go further, right? You look at the personal savings rate. There's a number of other things we could look at where it's just not. We are nowhere near the kind of strength to absorb a price shock as we were in 2022. Number one, but yeah, the duration of it really really matters as well, because if we go back to the math, damaged refineries, I haven't updated this, I think, since maybe 2 days ago. This is probably actually higher as more data comes out from some of the attacks. There was a recent, I think it was Saudi Arabia, there was a recent report that like half of the Gulf state oil refineries had been damaged. Half, right? Now, differing degrees of damage, right? But it's going to take some time to get that back online. The Qatari LNG plant that was taken offline by 2 drones, that alone was 3.5% of global LNG right there in one attack. 3.5%. And by the way, it's going to take 5 years to repair. 5 years. So
So,
yeah, you
so
have that
basically,
issue, but then you also have refinery shut-ins,
yeah.
right? Which take a while to get back online, because if you're an oil producer in Kuwait, you're making oil, you're putting it on ships, the ships are taking it to Asia. Okay, what happens when the ships can't get out anymore? Well, you fill what are known as inventories. This is the big tanks that you see, around a refinery. Those are called inventories. You fill the inventory up, you fill your tank, but once the tank is full, what do? You're not going to let the oil just like kind of ooze out onto the Arabian sand, right? So you you shut down the refinery, cap the well. Well, due to the physics of oil production, and I'm not an expert in that realm. I've just kind of gathered, from what I have read from experts in that realm. Once you cap a well, there's, oil's under pressure. And once you cap the well, you start to kind of mess with that pressure. It can be difficult to get that well back up to full capacity because you capped it, you messed with the pressure, and also just takes time to get it up and running again. You're talking at least 2 or 3 months, right? And that's 8 million barrels per day that is upstream of the Strait of Hormuz, that is just gone, that is shut in for at least 2 or 3 months, right? So that's not going to come back for another 2 or 3 months. Yeah, you do have the strategic stockpiles, right? The SPRs. But the problem there, 400 million barrels, the problem is the flow rate, which is 2 million barrels per day. Even if you just look at the refinery shut ins, 8 million barrels per day compared to 2 million, right? So like the math is just not looking very good. The oil on water, this is already almost gone in another probably 2 to 3 weeks. The oil on water will be gone. That was kind of a positive offset that we can see here. That'll be gone in 2 to 3 weeks. Like it's just not looking good. So you have the immediate impact, right? Because oil is very inelastic. What that means, it requires a very, very high price. The percentage change in the price of oil needs to be 10 times whatever you're trying to destroy demand. So, you're trying to destroy 20% of demand, you have to have a 250% increase in the price of oil, right? And so you're talking like $200 Brent, $250 Brent, depending on when you start, right? How much was priced in to the oil market, right? And where do you start that calculation? But you're talking like a 250% move in Brent. And that is just what is required to destroy the demand, right? Because you can't print oil. You have to destroy the demand. How do you destroy demand? With a higher price, a much, much higher price, because oil's inelastic, meaning that, if oil is up 40%, right? And I guarantee the people watching the stream are still driving to work, still driving to visit with family, right? Still living their life, right? So think what oil price change, right? What percentage increase in the price of oil would be required to get you to destroy a quarter of your oil consumption, of your gas, heating oil, whatever it may be, a quarter of your economic activity? Because every package you order from Amazon there's diesel, there's jet fuel, right? Like, you start going down that road to destroy 25% of global oil consumption, that would be the equivalent of taking the American economy completely offline to zero
And staying there.
and staying there. Yeah. And the American economy is obviously the largest economy in the world by a long shot, right? We're a quarter of global GDP, despite I think being like 7 or 8% of the population. We're a quarter of GDP, world global GDP. So to destroy 25% of oil consumption or economic activity, oil demand, it would be the equivalent of taking America to zero in the global economy.
So, from a timeline standpoint, you mentioned some of that oil and water in a couple of weeks being one of the line items that, from a positive standpoint, would be removed. Is that what you're tracking from a high degree of risk standpoint? Because there's no additional barrels that could potentially fill that void in terms of the markets potentially sniffing this out, or how do you quantify or attach some probabilities to different timeframes?
I mean, it's really hard. I would point to this. So I put this on yesterday, so it was probably the day before yesterday. Demand at some gas stations had increased by 300 to 400%. This was back when there was only 160 gas stations that were out of petrol. Now there's 500 out of petrol, right? Just in 2 days. So the hardest thing for me is to try to quantify panic, right? I can track barrels, right? And look at it like this, but how do you track panic? How do you quantify panic, right? To price in panic. And in markets, that is kind of sort of, how you get going back to oil here. I think it's a good parallel, which is that, going into 2020, here's the inverted oil price. Looks pretty similar to what we've seen, right? Inverted, right? It was going up, right? Back in 20, going into Q2 2020, it was going up, but I inverted it here because this is what it would look like now, right? And the reason is just the math, right? The math is very similar to the degree of disruption, right? So that's why we're doing this. You can very similar thing, it's trending. It broke out, and it broke out here in January 17th of 2020. Then look at what it did. It ran up, just like what we saw. It kind of had a pullback. Then it started to kind of really run up, and you can see it gapped down, right? But up in this case, gapped up,
Yeah.
right? And I think we could be like somewhere in this region, right? Look at what happened in order to get the 23 million barrel per day demand contraction, reduction in demand of 23 million barrels. Because supply, you have to remember back then, oil producers did not see that coming, right? They were still churning out oil like everything's fine. So the supply demand imbalance was huge. It was really equivalent to what we're seeing today, just the mirror image. And in order to get that supply demand imbalance to clear, the price of oil had to go negative $40. This is the daily chart, by the way. So each candle is a day. You started that day off at trading oil. Front month futures were trading at $18 per barrel. By the end of the day, they were trading at negative 37, right?
And
Imagine how many people were bidding at 0 or 10 cents, right? Thinking like,
yeah.
oh, this thing can never. and then it went negative, not negative $1, negative $2, and then right back. It went to negative $40, right? That was what was required. And so, if you overlay this, because again, it's just the mirror image of a 20 million barrel per day shock. If you overlay it with kind of where we are, I mean, it's tracking perfectly, which is kind of scary, you know? It implies, by the way, WTI going to 160, which
I
is
think
kind
it's
of like
completely
rough.
wild that we just forgot that oil was trading negative like
Yeah.
like 5 years ago, roughly 5 years ago. That
For
is
a day, right? It's very
yeah.
quick. Someone in a space yesterday was like, I'm going through all this math talking about oil and what mathematically must happen due to physics, right? And he, I think, was bearish oil. He's like, well, so you're long? And I'm like, no. And the reason is because number one, I trade options, and options only trade, a couple hours per day. This could happen at 12 a.m., right? And it could reverse within 2 hours. When you get that real true like price discovery, air pocket, whatever you want to call it, when you get that move, like there's not a guarantee that you're going to catch it, And so I'm just not trying to catch it, even though I do think that if the conflict drags on, the price of oil must go dramatically higher. And again, it's just math. If you look at that, there is a number, right? Economists love to have formulas, and there is a formula for what price is required. I think I mentioned it earlier, 0.1, right? Meaning that to destroy 1% of demand, price has to go up, or excuse me, to destroy 0.1% of demand, price has to go up 1%. So, you're talking about a 25% reduction of demand that must occur due to the fact that you can't print oil. You're talking a huge price, like an astronomical, $250, $300 barrel Brent is definitely possible, because the other part of it is speculators, right? To your point about traders, right? Imagine trading that moment. There were people piling in. Futures are levered, right? By definition, you need margin to trade futures. I guess technically you don't need it, but everyone trades futures on margin, right? So it's leveraged. And, there are speculators. And how do you quantify momentum, right? You can pull up the silver chart for like a good lesson in like how do you quantify the amount of speculation, right, that drove this thing, that doubled it, from 60 to 120. You can't quantify greed, right, and factor that into a formula. You can't quantify fear and panic and factor that into a formula. Like, it's just gonna do what it's gonna do in order to destroy that much demand, because it's just physics.
Well, that's why the smartest way to play this would be potentially via some kind of option strategy where you assign certain probabilities to certain outcomes and make bets based on that with leverage if you hit it right. And if you aren't right and that event doesn't occur, your downside is relatively small on a notional value. So
If you're just long calls, for example, yeah. Defined
exactly.
risk, yeah.
Yep,
Yeah.
exactly. So obviously, yeah, defined risk, 100%. I guess my follow-up question then is, if there is this potential spike that's not being priced in, if it happens, and let's say there's a 5 or a 10%, or maybe you think there's a higher chance than that of happening, maybe 30 or 40% of a significant spike in the oil price, should I be setting my bids at Bitcoin down in the 40s just in case we wick down there? Because I'm not going to be able to time that oil price spike, right? And I'm not necessarily a macro trader where I'm bidding on oil futures daily and able to account for that. But I do have a River account and an account with Rhino as well, and they allow for certain auto bids in their software. So should I be bidding down in the 40s and 30s, hoping for a wick down there, with the view that now, if ever, was a higher probability that that could happen than in the past?
I mean, what I'm doing is building cash, because cash is a position, right? Even though it's much hated and right, all that kind of thing, cash is a position. If you're uncertain about the future, right now cash is yielding 3 1/3.
Well,
You
sorry,
can just,
it's only hated if you hold cash long term, I think is
or
hated because,
yeah, or
right?
without interest. right? Or
Or
if inflation is higher than the interest rate. Yeah.
correct,
Yeah.
real wealth, because you want to
Re-
hold real wealth over the long run, right? So I
Yeah.
do understand people who are like reticent to suggest cash as a high percentage of their portfolio position over the long run, but again, in the short run, I think it's totally logical if
Yeah, over short, medium term, I'm like 35% cash right now, and I'm trying to get to 50. Um, and yeah, and the reason for that is I think that, there's a pretty strong likelihood that, we get something equivalent to this, and when the market wakes up to look, it feels very similar to like January 2020. This is the only parallel I can really draw. I was following all the developments out of China, every preprint publication on the transmissibility and the fatality rate. I was reading all that. I was watching all the videos of people, like filled up hospitals and all that. And I'm trying to tell people, right? People around me, I'm like, guys, like this is really bad, I think. I'm not a virologist, but it looks really bad. It's gonna come here and it's gonna be really bad. And they're like, oh, yeah, baseball game's on at 5 p.m. It feels very similar to that, where you're just like a month away from reality hitting, and there being, no toilet paper, no food,
or
locked in your
you walk into
house.
the gas station and all of a sudden gas is 50% or 30% higher than it was last week. Like that's a real probability that I think a lot of people aren't
Yeah.
necessarily aware of, because it's not something that human nature would teach you to like expect on a daily basis. That's a pretty substantial shock, and it's psychologically not human nature to expect those kind of changes in our habitual.
Exponential. Yeah.
Exactly. And the
Yeah.
also the knock-on effects of some of these things are incredibly complex, and something, if you aren't necessarily like a macro analyst, or you aren't following a lot of these you know data sources like you are, it's difficult to have that moment where you realize the similarities between what happened before and what's potentially going to happen again.
Yeah. So, like, just to kind of compare it to '08, what we saw, that the amount of economic contraction needed to destroy 20-ish million barrels of oil consumption, the amount of economic contraction was 235% worse than the worst part of 2008 great financial crisis. This is GDP going back all the way to 1948. Right. And you can see it was 183% worse than the next closest recession, which was back in 1958. So it's just like really, really, really bad. And yeah, that you asked about depression. Like, if that level of economic contraction continues for a year or two, like, if refineries start, if this war escalates, right, and we start doing whatever and it makes them unhappy, so they retaliate and start going after GCC oil infrastructure, and Ukraine is still going after Russia. They're using this as, I think, in it, like they're going after their oil infrastructure. Like, if this really starts to kind of like spiral, that oil is not coming back online for years, right? So that's kind of how you get into like real depression territory, global depression, not just America.
Well,
And
yeah,
so it
let's define that depression, because there's a lot of different ways of thinking about this, from a job standpoint, from a GDP shock standpoint, from the time of a potential recession lasting. So when you say depression or global depression, what specifically are you referring to? Just a GDP hit to global production and global consumption, or
if the war continues for, I don't know, another month and I mean, it's really hard to say kind of when the turning point is going to be, but if it continues for another couple months, say, then you're looking at a prolonged period of widespread economic contraction. That means deflation, right, rather than inflation. That means that, the cost of things is going down every single year, like Japan. Japan had it, for decades, really. They had deflation, where instead of everything going up 3, 4, 5, 6, 10% a year, it was going down 2, 3% per year. So you have deflation. Now they will try to counter that because deflation is terminal. to a debt-based, highly levered monetary system, right? So they will definitely try to fight the deflation, but for period of time, you can have deflation, and then the economy will be shrinking, so unemployment will start going vertical, like it did in '08, like it did in 2020. You'll have, widespread job loss. And oh, by the way, all this is, occurring at the same time that, we were just talking about AI, and the disruption to the labor market from AI. If you look at private credit, which by the way is tracking software due to the fact that about half of private credit loans are to software companies. Software companies are being disrupted by AI. Private credit was already having issues. You can see private credit started to sell off. You could say early January, or you could say, all the way back in mid 25. Private credit has already kind of been under stress. You already have the AI deflation, right? And then you add this, it's it's a severe deflationary shock. So unemployment up, labor market down, deflation, cost of goods down, meaning things get cheaper, meaning if you're holding cash, especially interest bearing cash, aka US treasuries, your purchasing power is going up a lot, actually, by holding US treasuries. Now, this period of time is probably going to be, pretty short, because deflation is terminal to a highly levered debt-based monetary system. And we're already running a huge fiscal deficit. In the world, in a vanilla garden variety recession, you're probably talking 14, 15% of GDP deficit. If this was like, if it goes on another couple months and you're talking depression, you're talking about a fiscal deficit probably 20 to 25% of GDP, which is just like la la land, emerging market, banana republic, hyperinflation, whatever you want to call it, like just la la land territory. You're talking 5, 6, 7 trillion dollar deficit. Well, of course, that cannot be absorbed by the bond market. What that will require is the Fed to come in, print bank reserves, and QE, right? And buy the debt. They could even directly monetize the debt in that kind of situation. Also, private credit is going to be blowing up. They're going to need to backstop that, deal with that. Mortgage market, 12 trillion, that'll be blowing up. You're going to have to backstop that. The amount of money that they will have to print, is going to be astronomical. So, like again, Bitcoin has never even seen a recession, let alone a severe recession. You could argue 2022, right? We got 2 quarters of negative GDP. We had a bear market in the stock market, right? From an oil price spike, by the way. That was what caused 2022, the shadow recession, that the definition was changed
Yeah.
right. You did get basically a recession. So it was mild though. It was very, very mild. You could argue that, we kind of saw
COVID
what
was,
Bitcoin.
I mean, like, to be fair, COVID was a pretty recessionary period for Bitcoin. So yes, it was in the infancy of Bitcoin still, but it was only 6 years ago now, right?
Yeah, but it was also very abrupt. It was very rapid. It was boom
Well,
and
this
then
would
print
also
the
be
money.
potentially abrupt, right? I mean,
Yeah,
if
no,
it
for sure,
is
for
a
sure. Yeah.
recession or even potentially a quote unquote depression, depending on the extent of the GDP shock caused by the time at which oil stays elevated,
Yep.
this has to be a short-lived recession, because if it isn't, then there is no real outcome other than
Well,
a
yeah, because like
depression where
the yeah, like the fear, or the way it could turn, because the reason oil will go to 200 or 250 or whatever, 150, whatever it is, the reason oil will do that is to destroy demand. Well, once demand falls by 20 million barrels per day, demand and supply are in equilibrium now, right? And so, the price of oil is going to collapse. It's who knows where it collapses to. It depends how many refineries are shut in, how many are damaged, right? It depends on a lot. Policymaker response, how much money are they printing? It depends on a lot. But the price of oil will come in sharply. And supply and demand will now be in equilibrium. So we definitely could have like a V shape. I mean, don't put it past them, especially Trump, especially if this all kind of plays out before November. I mean, we're in March, right? Don't put it past them to like print $10 trillion
And sorry, wouldn't this be the
and
perfect
airdrop it to.
response to garner votes? I mean, who doesn't want free money? Like, I mean, we've seen this
Yeah,
playbook
yeah.
before. This is setting up perfectly for Trump, right? I mean, all you
Or
want is the ability to influence and hand out money to people in exchange for favor and votes and influence. I mean,
yeah, I guess like I'm prepared for very low Bitcoin price. I said it on a different stream and made a bunch of Bitcoiners very, very unhappy. And I don't know what to tell you. Like, don't be levered. Is my personal advice. I'm not levered, and build cash because man, the part that they missed is if we get 10K Bitcoin, 20K Bitcoin, whatever, right? Very low Bitcoin, you're going to want to have the cash to buy that dip because then it is going back to, I don't know, 150, 250, 300, something, right? Higher. The 10x opportunity, right? The buying Bitcoin at 16 here at the lows of the kind of the last energy crisis, right? From 16, you almost 10x that. I'm bad at math, but probably what, 8.5x, like that opportunity is coming. And
yeah,
you would
I,
think that
I
Bitcoiners would be excited about that, but rather they're like, it could never happen. It's like, well, it's just physics, dude.
It is
Like,
just physics, but I will push back on again psychology. And if a lot of the OGs have, let's say, sold at 120K all the way down to 60, I don't see any necessarily sellers left
well,
at
but think about it. But think about it.
30. Like,
You
I mean, you
think
will
about it.
argue all risk assets just are correlated to one, like they
Yeah,
did in the GFC.
exactly.
I'm sympathetic. I'm empathetic to that, right? I do see that as a potential option. But I mean, you would really have to like be scraping the bottom of the barrel in order to get down to a 16K, unless there is some on-chain liquidation event like an FTX where there is all of a sudden this market-wide leverage. And I feel like most of that leverage has been flushed out by now, and most of it was institutional buying. And if they've left, they've left.
Yeah, but think, you're an individual, unemployment rate's 25%. You have a mortgage to pay. You have no income anymore, right? Unemployment's paying you $300 a week. You're a business that accumulated Bitcoin. We're in a recession, if not a depression. You have no income, right? Like there will be forced sellers, but not due to trading stuff mechanics, right? They will be forced sellers due to the fact that economic activity has collapsed to Q2 of 2020 levels, right? And you still have bills. That's why deflation is so terminal, is that it becomes this, right? If you don't sell your Bitcoin to pay your mortgage, or let's use a better example. If you don't sell your Bitcoin to raise dollars to pay a credit card bill, that money, that money got destroyed. That is deflationary. Well, what happens when 20% of Capital One's credit lines default?
I don't disagree with that.
Capital One starts to get into trouble, right?
True,
Who
true.
has Capital One equity?
But
That capital gets destroyed,
yes,
and
but
on and on.
if you look at most high net worth individuals, that and we're about to go into a quote unquote recession or even a deflationary, you know, shock. I don't necessarily see those high net worth individuals or those corporations who are ideally well capitalized. Again, I think most of the holders who are holding down to 60K are going to hold down to 20K because their lifestyle is not necessarily going to be directly impacted by a temporary 1 or 2 quarter recessionary shock. So what you're arguing for is, hey, there's no leverage might not be the cause that we go down to 16K Bitcoin again. And I'm saying I think that the people, the makeup of the market at the moment is predominantly the Bitcoiners that are holding Bitcoin are not necessarily your average Joe who's going to be forced to sell that Bitcoin at those low levels.
That's it's entirely possible. I don't know. I
See,
don't look at
I
the.
mean, I'll
I
put bids down at 16K. I just hope that they'll never get hit. I would
Yeah.
be very surprised personally, like if we saw a wick down there that wasn't just
Yeah, but
Because
think about it, like compare it to 2022, right? Like from 2022 to, from the high of the low, think about that was basically 2 quarters of like we didn't I don't even think back then we printed negative 0.5 on GDP, right? In Q2 2020, we printed negative 31%, right? If I don't know, it's just it'll be unlike anything we've ever seen. Really, I mean, the only kind of parallel will be 2020, and we know stocks went vertical
what was the
in the wrong.
drawdown from 2020 for Bitcoin? And if we overlay that from 120K down, what would that give us as a price? Because my gut would be somewhere between 30 and 40K as the low. If there was
From 2022 is probably like, I think this is probably, I mean,
okay, so what percentage drawdown is that?
76.
75-ish percent. So 75%
Yeah.
down from 120K is what?
Well, if you're going to measure from that high, you're talking like 25K. But if you measure it from, say, this high back in early January,
Well, I mean, that's being a little bit selective. I think that the
it's
high is
20.
somewhere in the 120s, right? And 75%
Well, no, but
30K. So for
right,
me, that's like
but if you look at when the energy, I'll overlay oil, because you have to look at like when did that actually start, right? Oil started moving higher here, right? Basically at the local low.
yeah.
Oops. So all I'm saying is like, you could get, 20K Bitcoin.
Yeah.
And and look, like I'm still very long. I'm not short. I didn't sell my Bitcoin. Like,
It's a Bitcoin show, so I feel like I have to do my part in pushing back too. But
yeah, no, for sure. I am not short, but I wouldn't want to be short Bitcoin because, my confidence in the move lower on Bitcoin is not high enough to make it appealing for me, right? As a trade, as a risk reward, the confidence is just not like I would rather just build cash and wait for a dip. It might not be in Bitcoin, it might be something else, like
yeah.
kind of thing. I would rather do that than try to short Bitcoin or sell Bitcoin because it has held up very, very well since the start of the war. It's outperformed gold. It's outperformed the S&P 500. Here, we'll do gold, which I think is I think we should be comparing Bitcoin to gold, a lot more often. So going back to the start of the war, which was here, we have outperformed gold by 27%, right? That's crazy in just a month or so. That is a lot of strength. Now, this is the long-term trend, we've underperformed.
I'll say that much.
Say that again.
Peter Schiff is in shambles.
Yeah, yeah, we got our bounce. Yeah, we found our low.
Finally got our
Bitcoin
bounce.
gold. Yeah. Now it's time to go long Bitcoin and sell gold.
Yeah, or we retest those lows
Calling
again with a massive spike in oil, and then we're off to the races. So
actually, is it breaking out? Let's see. Look, it's kind of breaking out.
yeah, I mean, technical analysts, I don't know. You
Doing
drew that line straight through that second little bump up there.
Oh, they might not like that.
No, it's got to be very precise. Hold on. Yeah, it's close. It definitely looks like it might be a breakout. Who knows?
But there's all sorts of third, fourth, fifth order effects, right? Like, Europe in this example, Asia, they're going to be screwed, right? They are net importers. They're short oil and they're short the dollar. So, their energy bill's going to be just immense. We can see, for example, France, right? During 2022, their current account went from a surplus here of about 12 billion euros to a deficit of 63 billion euros. And I think this is per month. So, you're talking like huge burden on Europe, on Asia. We know they've accumulated a lot of US treasuries, a lot of US stocks. They're going to be selling, and so what does that do? Well, if you're selling US treasuries, you'd cause dollar milkshake theory, right? Like a reflexive move in the dollar and in rates that is not going to be good for America. Because remember, the other constrictive effect, not only do we have oil moving higher, restricting economic activity, we have interest rates, bond yields also moving higher, restricting economic activity, whether it be mortgages, cars, whatever, personal loans. So you already have the constrict. You start getting foreign selling of US treasuries causing like rapidly rising rates. You could also cause a debt crisis in America, right? Our interest expense is already a quarter of our tax revenue. You could cause, right? So there are so many like third, fourth order effects that people need to really try to think through. And then, they dump US equities. What does that do? It destroys the wealth effect for the top 10% who are propping up 2/3 of GDP, or half of 2/3 of GDP just gone because wealth effect goes negative. What does that do? It plunges the US into a deeper recession, causes more job loss, higher job.
Yeah.
Like you have to really like kind of get it to try to figure out, where it all goes. But the short answer is they're going to come in and they're going to print a lot of money, like really a lot of money.
Yep, which is exactly why you need that cash position in the first place, to be able to deploy when everyone else is hopefully, selling,
Yeah.
freaking out as to whether or not this depression is going to last for 1 quarter or 10 quarters.
Yeah. Yeah. You don't want to be holding cash when they start the 500 billion per month QE, right?
Yeah, the technical term is gazillion dollars of
Yeah.
So anyway, Infra, we've ran a little bit over, just shooting the shit, but thanks so much for coming on again. Thank you everyone who's tuned into the stream. We appreciate all of you. Please feel free to give us a like. If you want to check out Infra, his show is Economics Unmasked on YouTube. So go check him out. He's got some really good, even more thorough data-driven analysis on his YouTube channel. We're going to call it there, everyone. Thank you for watching. And Infra, once again, thanks for hopping on to the Daily Stack Macro Edition.
Thanks for having me.